Imagine waking up to news that the stock market has plummeted overnight. Numbers flash red across your screen, headlines scream disaster, and suddenly, your carefully planned investments feel like they're disappearing into thin air. Panic sets in. You're not alone. Market crashes aren't just about numbers, economics, or financial systems, they're about human psychology. Behind every sell-off, every sudden withdrawal, and every rash decision is a fundamental truth: fear drives behavior. Understanding the psychology behind market crashes is key to recognizing why we panic, and why those panics often amplify the very events we fear. Human beings are wired to respond to threat, and financial markets trigger the same primal instincts. Loss aversion, a concept in behavioral economics, explains why losing $100 feels far worse than gaining $100 feels good. During a market downturn, every drop in portfolio value activates this instinct. Investors start to sell, not because their analysis says it's smart, but because fear of loss overrides logic. This isn't irrational, it's deeply human. Our brains prioritize survival over profit, and in the context of money, survival instincts manifest as panic selling. The irony is that by reacting emotionally, we often contribute to larger market declines. Herd behavior compounds this panic. When investors see others selling, they fear being left behind or suffering greater losses. The mind instinctively looks to the crowd for guidance during uncertainty. If everyone else is fleeing, it feels safe to flee too. This creates a feedback loop. Selling begets more selling, driving prices down further and amplifying fear across the market. Herd behavior doesn't just apply to small investors, it affects fund managers, institutional investors, and even entire sectors. Market crashes often accelerate because humans, even highly trained professionals, are influenced by social cues and group psychology. Cognitive biases also play a significant role in market panic. Confirmation bias, for example, leads investors to focus on information that supports their fear while ignoring evidence of stability. If the market dips, the mind selectively notices bad news, earnings misses, negative reports, or warnings from analysts. Optimistic signals are discounted or rationalized away. Anchoring bias can make people fixate on past highs or reference points, so any deviation feels catastrophic, even if the market is only temporarily volatile. These biases twist perception, making crashes feel worse than they are and fueling irrational decisions that worsen the downturn. Emotions like anxiety and regret heavily influence market behavior. When prices drop rapidly, fear triggers stress hormones that impair decision-making. Investors may sell too quickly to avoid regret, even if holding would be more rational. Similarly, the anticipation of future regret selling too late or missing an opportunity creates pressure to act immediately. Panic isn't just a response to current losses, it's also a fear of future mistakes. This emotional layer explains why even experienced investors sometimes abandon carefully crafted strategies during market turmoil. Market crashes also expose the illusion of control. Investors often overestimate their ability to predict outcomes or manage risk. When unexpected events like sudden economic reports, geopolitical tensions, or corporate scandals shock the market, it undermines this sense of control. The resulting anxiety triggers panic behaviors. People crave certainty in uncertain times, and the market's unpredictability magnifies that need. In trying to regain control, investors act impulsively, selling assets or withdrawing funds, often making losses more severe. The media plays a surprisingly powerful role in fueling panic. Dramatic headlines, 24-hour news cycles, and social media amplification make downturns feel immediate and catastrophic. Every negative report reinforces fear, creating a collective anxiety that spreads faster than the market's actual fundamentals. Investors interpret news emotionally, not analytically. Reports of bankruptcies, layoffs, or declining indexes trigger instant reactions, even if the underlying economic indicators remain stable. The amplification of fear through media creates a self-reinforcing loop where panic feeds panic. Psychological contagion is another factor. Just as a yawn spreads in a room, fear spreads in markets. When a few prominent investors or influencers act out of fear, it signals danger to millions of others. social proof, and perceived expertise magnify this effect. Even those with experience and knowledge can succumb to collective panic when signals suggest a larger threat. The market, in this sense, behaves less like a rational system and more like a network of emotionally connected individuals reacting to perceived threats in real time. Historical patterns show how psychology dominates market crashes. During the Great Depression, the panic wasn't triggered solely by economic fundamentals. It was fueled by fear, rumors, and mass selling. Similarly, the 2008 financial crisis saw widespread panic as investors realized the scale of mortgage defaults. Even though some institutions were sound, the fear of systemic collapse led to a chain reaction of withdrawals and fire sales. Psychology, more than logic, dictated behavior, and those reactions shaped the trajectory of the market crash itself. Losses feel personal, even when they're abstract. Most investors don't see market declines as statistical events, they see them as personal setbacks. A portfolio dropping 20% can feel like a personal failure, triggering shame, guilt, and stress. This emotional response drives the urgency to act, often hastily. Rational analysis takes a backseat to emotion, and the fear of losing more overrides long-term planning. In this way, market crashes aren't just financial events, they're emotional crises on a massive scale. Risk perception is magnified during crashes. Humans are naturally prone to overestimating low-probability, catastrophic events when anxiety is high. A small decline becomes a signal of impending doom, even if historical data suggests recovery is likely. The brain's pattern recognition instinct looks for trends, and in volatile markets, it sees negative patterns everywhere. This leads to overreactions, reinforcing downward trends, and further fueling panic. Investors often act on perceived risk rather than actual risk, which is why markets can fall faster than logic would predict. Another factor is short-term thinking. Crashes highlight a human bias toward immediate outcomes over long-term consequences. Investors focus on daily losses rather than decades-long growth potential. This myopic view intensifies panic selling, as the mind prioritizes avoiding immediate pain over long-term strategy. Ironically, this short-term focus is exactly what private investors, fund managers, and institutions warn against during stable times, but during panic, even seasoned professionals can succumb. Fear also triggers over-leveraging reactions. Investors who had borrowed to amplify gains may be forced to sell when losses mount, creating forced liquidity events. These actions compound declines, creating feedback loops of fear-driven selling. Even healthy companies can be affected if markets overreact, illustrating how collective psychology can disrupt economic fundamentals. Crashes are not only a reflection of reality, they are shaped by the behavior of millions, reacting simultaneously to uncertainty and threat. Hope and optimism play a role as well, though often delayed. Recovery phases are slower because human psychology is more sensitive to loss than gain. Even after markets stabilize, fear lingers. Investors hesitate to re-enter, needing confirmation that the threat has passed. This delayed optimism explains why recoveries often feel sluggish, even if the fundamentals have returned to normal. Panic and fear don't dissipate as quickly as numbers improve, and psychology lags behind reality. Education and experience mitigate panic, but they don't eliminate it. Investors who understand market cycles, diversification, and historical patterns are better equipped to remain calm. Yet, the human brain still reacts emotionally to sudden drops, especially in large portfolios or high-stakes environments. Awareness of psychological triggers, loss aversion, herd behavior, fear of regret is crucial for anyone navigating volatile markets. Recognizing that panic is often the default response allows investors to step back and act strategically, rather than emotionally. The modern market also amplifies these psychological effects through technology. Real-time trading, algorithmic triggers, and instant access to global news create a pressure cooker environment. Decisions must be made in seconds, and social media accelerates emotional contagion. This immediacy intensifies the psychological triggers behind panic, making market crashes feel more volatile and immediate than they may be in reality. The faster the news travels, the faster fear spreads, creating almost viral reactions among investors. For viewers, the key takeaway is that panic is natural, but it doesn't have to dictate outcomes. Awareness of psychological triggers, historical patterns, and emotional biases allows investors to step back, make rational decisions, and even find opportunities amid chaos. The very behaviors that amplify market crashes are predictable once understood. By recognizing fear-driven patterns, we can act deliberately rather than react impulsively, turning potential panic into strategic advantage. In the end, the story of market crashes is the story of human psychology writ large. It's about fear, perception, and the instinct to survive in uncertain times. It's about how emotions can magnify financial events, turning corrections into crises and volatility into panic. But it's also about the potential for rational action, discipline, and foresight to mitigate fear. By understanding why we panic, we gain control over our responses, and in doing so, we can navigate markets with confidence, even when others are driven by emotion. So next time the market tumbles and panic grips headlines, remember, the numbers are only half the story. The other half is human psychology, the fear, the herd mentality, the biases that drives the storm. Recognize these forces, pause, and resist the urge to act impulsively. Market crashes may be inevitable, but panic doesn't have to be. Understanding why we react the way we do is the first step to mastering not just investing, but the emotional dynamics of money, risk, and human behavior itself.